Hello and welcome to Market Index and Livewire Markets C-suite coverage of reporting season. I'm Carl Capilingua and I have the pleasure today of speaking with Rob Scott, CEO of Wesfarmers, who's here to talk about the company's latest results and outlook. Rob, thanks so much for joining us.
Thanks, Carl.
Wesfarmers has just released its first half results. Rob, how would you describe your performance?
Look, I think the results were very solid and pleasing across the board. To be able to grow profit by 3% in an environment where our chemicals business we knew was going to have lower earnings was a really strong effort, and our retail businesses did a great job to move their sales and profit forward in a very challenging consumer environment.
Recent business surveys suggest that the retail sector is doing it tough, yet Wesfarmers retail brands beat expectations. What would you attribute to that better than expected performance, and how do you think the Australian consumer is holding up?
All of our businesses really take a long-term approach to value creation, and it was quite clear in recent years that we could see inflation going up, we saw interest rates going up, and our retail businesses, notably Kmart, Bunnings, Officeworks, really focused on trying to drive greater efficiency to keep our prices low, really doubling down on their value credentials. We've dropped thousands of prices over the last 12 months across our retail businesses. And I think a brand that really showed the value of getting the offer right was Kmart, and we saw very strong growth in sales and profit. And that was really a classic, I think, a win-win scenario of by lowering prices and helping customers save money, we were able to grow sales and grow profit and deliver a 26% growth in earnings at the same time as helping many households at a time of need.
Rob, we're cycling through one of the worst supply chain disruptions in over 40 years. Where do you still see pressure within your supply chain, and where do you see improvements?
Well, Carl, we learned a lot about our supply chain through the COVID period, where there were incredible disruptions on both the demand and the supply side, and that enabled us to build a lot more resilience into our supply chain. And also we're now using a lot of data and technology and digital capabilities in a more sophisticated way to predict demand, to monitor product flows through the supply chain. So we've seen a real normalisation, and it's put us in a position where we're better able to handle some of the short-term pressures. So the latest issues in the Suez Canal that then flowed through to a global disruption in ships and containers, we were able to manage some of that volatility quite well in recent months. The challenges in supply chain really just come back to various global disruptions that happen from time to time, but we also shouldn't lose sight of some of the domestic challenges. You know, we have seen heightened industrial relations in Australia, particularly around supply chain, with the wharfs, with transportation, and that is something that obviously businesses need to manage, and ultimately it adds to inflation. So we're doing our best to try and manage these supply side risks, and I think our businesses are in pretty good shape. And I guess the best test of the quality of a business handling supply chain is availability in store. And our availability in store in Kmart, Target, Bunnings and Officeworks has been in pretty good shape this year.
Inflation is one of those, has been one of the most important topics over the last 12 to 18 months. And there's been plenty of criticism about how some companies have handled price increases versus profitability. What's Wesfarmers doing to try and minimise the impact of rising prices, which are in many cases inescapable, while still balancing the needs of shareholders?
What helps businesses like Bunnings, Kmart and Officeworks is their whole reputation as a brand is grounded in everyday low prices. We have price guarantees. We monitor thousands of prices every week to ensure that our prices are as low as they can be. So there is a really good culture within these businesses that if we see costs come down, then we're happy to give that back to customers. And we know that by doing that, it will drive sales and create a stronger business. But as you also said, there are many cost pressures out there. Sometimes prices need to go up, but we will do everything we can to try and mitigate those price increases through investing in technology and smarter ways of working. So, so far I think our retail businesses are managing that pretty well. And I think the true test is, are we offering great value to customers? And the fact that our sales have gone forward and businesses such as Kmart are doing well, I think shows that they're doing something right for customers.
I'd like to change tack a little bit here, Rob, and ask about your sort of healthcare brands. And just noting that Sigma's reverse takeover of Chemist Warehouse, effectively is what it is undoubtedly going to significantly increase competition in that space. How do you feel about that increased competition, and what are your plans to tackle it?
Well, I'd say Chemist Warehouse is a very formidable business and competitor, and I think this latest transaction that's been announced, it'll be interesting to see how it plays out. Obviously, it's still in the works. In addition, for Chemist Warehouse being a competitor of our businesses, they're also probably the number one competitor of community pharmacies. And our API wholesale business is focused on supporting community pharmacies. So look, I would like to think that there are opportunities that will emerge for our health business, for our Priceline network, for our API business, that will be able to provide even better services to community pharmacies and hopefully grow share with community pharmacies that are fighting really hard to compete against Chemist Warehouse. So it's early days. It doesn't change our strategy. We're optimistic about the future of our healthcare business, and maybe there are some opportunities for us to win some new business if we can help community pharmacies.
What's just amazing about the Wesfarmers model is we can talk about retail like Bunnings and Kmart and Target, we can talk about healthcare brands, but then we can go completely off topic and talk about something like lithium, which is obviously suffering at the whims of the commodity, the dreaded commodity price cycle at the moment. You've made a significant investment in the Mount Holland project. It's come in, let's say, a little bit over budget so far. How do you see that project progressing? Are you concerned about the current level of commodity prices? What's your outlook going forward?
Yeah, look, well, we're actually quite pleased with how our project's going. We've only just started the commissioning and ramp up of our mine and concentrator. That is going very much to plan. And then we're 65% through the construction of our hydroxide refinery. So the project very much on track. You're right that the costs of development are a bit higher than we expected. We initially set our prices at a time before inflation kicked in and before COVID came along. So we have had to deal with that, but we've actually mitigated those costs pretty well. So these short-term movements in lithium price, it may well reduce the amount of profit we can achieve from some interim spodumene sales, but it doesn't fundamentally change the overall economics of our project. We believe that we can still generate very good returns from being a reliable Australian supplier of hydroxide.
Are you looking to make any future metals?
Well, we have still more to do with our lithium project, and as I said, 65% through the construction of our refinery, so we really want to get that over the line. We also have options to invest more in the expansion of our Mount Holland lithium project, so there's more to do there. We're also looking at various opportunities within our Wesf business around green energy, around decarbonising our ammonia business. We've also just recently undertaken a program to invest in some forestry assets to help develop the ACCUs to help mitigate carbon emissions. So there's a whole range of projects going on. We'll continue to look at other investment opportunities, but they obviously need to stack up on a financial basis to progress with an acquisition.
Or do you think there's enough value out there to start looking at some of these other current producers?
Well, Carl, I think it's much better to invest in an asset and buy a business when everyone's incredibly fearful and panicking and doesn't have access to capital. That's a much better time to buy than when everyone's talking about booming prices. So as you'd expect, we look at a lot of opportunities. We just recently invested a fairly modest amount of capital in a partnership arrangement with Ora Banda, which is a very lucrative lithium site and asset, and we have a very strong geologist team that discovered the Mount Holland project that are now focused on that partnership with Ora Banda. So there's many things that we have in the works, and who knows, maybe other opportunities may come along.
Who knows indeed. Look, you mentioned Wesf earlier on, and if there is probably one weak point in today's results, that would be it. What would you attribute to the disappointment there, let's call it, and what are you doing to turn that around?
Yes, well, it's at a financial level, obviously the earnings dropped a fair bit. They dropped around 40%, but from an operational performance level, the team did a great job. And really, the lion's share of the drop in earnings was just simply a function of ammonia prices fell significantly. And we are a manufacturer of ammonia. We use a lot of ammonia for the various products that we sell to farmers, to various miners. We've benefited from high ammonia prices in recent years, which flowed through to our earnings. And as the ammonia price fell, then our earnings have fallen. But overall, it's still a good return on capital. The business is performing well. But these are one of the things that happens in businesses that do have some commodity exposure.
Rob Scott, thanks for your time.
Thank you.